Imagine being like the smartest person in a room,
Right.
having a literal genius level intellect, and um, still managing to lose your entire life savings on a random Tuesday afternoon.
Yeah, it sounds crazy, but it happens all the time.
It really does. Because usually when we talk about a professional career, there is this expectation of, linear progression. In engineering or medicine, you study hard, you acquire more knowledge, you gain experience, and the math is just simple.
Experience equals competence.
Exactly. But step into the world of active trading, and your own brain is actively trying to bankrupt you.
It is the absolute definition of an environment where intelligence alone, it just does not guarantee survival.
Right.
In a lot of cases, a high intellect actually works against you because
Yeah.
you start believing you can outsmart what is essentially a chaotic system.
Well, welcome to this deep dive. Today, we are exploring the actual mechanics of market survival and trading psychology.
Yeah, it's a huge topic.
Our mission today is to completely strip away all that vague, bumper sticker trading advice you see online.
Mhm.
We want to equip you with the concrete binary rules, the strict risk math, and the actual institutional data tracking techniques that professionals use.
And we have some really phenomenal sources to build this framework for you today.
We do. First, there's a rigorous guide from Trader's Second Brain, and it's called 20 Trading Rules That Actually Stop Bad Trades.
Excellent piece.
Yeah, and we are pairing that with an operational manual from 4Traders titled 7 Risk Management Strategies for Day Trading Success.
Right, and to look at the broader market, we have this really eye-opening breakdown from Forex Fundamentals. It explains why most retail traders completely misread the CFTC's data, and that one is called CO Report Explained.
So let's just start with the fundamental difference between a consistently profitable trader and a gambler.
Okay.
Because it isn't market intuition,
Yeah.
right? It is the systemic, ruthless removal of decision-making during moments of high emotion.
Yeah, the core tension here lies in human biology. I mean, your analytical brain is phenomenal at planning when the market is closed.
Oh, sure, when the charts aren't moving.
Exactly. You can draw beautiful charts, map out all these scenarios, but when the market opens, when prices are flashing red and green and real money is actually on the line, your emotional brain, your amygdala, it just takes over.
The fight or flight response.
Right. And if you have to make a choice in that high stress moment, you will almost always make the wrong one because your body is literally reacting to a perceived physical threat.
So if your rules are flawed, no amount of technical analysis is going to save you.
None.
And the sources point out this brutal truth, which is most traders don't actually have rules. They have wishes.
That is so true. They have these vague guidelines like manage your risk or be patient.
Right? And when you are under pressure, your brain will rationalize literally any behavior to fit that guideline. You tell yourself, oh, I'm being patient. I'm just, giving this losing trade a little more room to breathe.
Yeah, which is a critical distinction. A true rule must pass an objective binary test for compliance.
Meaning a simple yes or no.
Exactly. According to the journal data from Trader's Second Brain, traders who use specific binary rules have a 31% higher consistency score than those who use vague guidelines.
Wow, 31%.
Yeah. You have to ask yourself, could a total stranger look at your trading journal and objectively score whether you followed your rule? It has to be a yes or no.
Think of it like a bad New Year's resolution.
Oh, good analogy.
If you tell yourself, I want to eat healthier, that plan instantly falls apart the second you walk into an all-you-can-eat buffet.
Right. What does healthier even mean when you're staring at a huge tray of brownies?
Exactly. But if your rule is, I will consume under 2,000 calories today, well, that is a measurable binary constraint. You can't argue with it.
To put that into market terms, we have to look at the most important binary rule of all. It's really the absolute anchor of risk management.
The 1% rule.
The 1% rule. You must never risk more than 1% of your total account equity on any single trade. Everything else in your trading framework flows from this single mathematical constraint.
It sounds so conservative, though. I think a lot of people hear 1% and think, well, I'm never going to grow my account at that pace. Why is this number non-negotiable?
We have to look at the unforgiving math of drawdown recovery. Drawdowns are entirely asymmetric.
Meaning, what goes down doesn't come up at the same rate.
Right. If you lose 50% of your account, you do not need a 50% gain to get back to where you started. You need a 100% gain just to break even.
That is rough.
Let's map out a losing streak, because every trader, no matter how good they are, they will eventually hit a streak of, say, 10 consecutive losses. It is purely a matter of probability.
Okay, so if you hit 10 consecutive losses risking 1% per trade, your account is still at roughly 90.4%,
Yeah.
which is annoying, obviously,
Mm.
but it is highly recoverable in a few days when your edge returns.
Now compare that to risking 10% per trade, which, let's be honest, many beginners do because they want to double their money in a week.
Oh, absolutely.
10 consecutive losses at 10% drops your account to roughly 34.9% of its starting value. You have wiped out 2/3 of your capital.
Wow.
You now need a massive, almost impossible return just to get back to flat. You are functionally game over as a trader on that capital base.
So the 1% rule basically ensures that when your strategy goes through its inevitable losing cycles, you survive long enough for the winning cycle to return.
Exactly. Survival is the whole point.
Now, the sources emphasize that you shouldn't just try to keep this discipline in your head, right?
Yeah.
You have to track your compliance in a journal.
Yes. The goal is a 90% compliance score across all your rules.
And when you break a rule, you log the emotional trigger and, crucially, the exact financial cost of that specific violation.
Adding a dollar amount to your lack of discipline completely changed your relationship with the rule.
How so?
Well, when you see that moving your stop loss on a whim just because you were scared cost you $500, it stops being a psychological abstract. It becomes a very expensive behavioral problem that you're just forced to confront.
Right. So setting a 1% rule is easy in theory. But when you are actually staring at a chart, how do you translate that percentage into actual contracts without, guessing?
Yeah, you can't properly execute a 1% risk rule if you don't know the exact math of position sizing.
Let's get into the math then.
Position sizing is a strict formula. It should never be based on how confident you feel about the setup.
Okay.
The formula is your account risk in dollars divided by your stop distance equals your position size.
Let's do the math on that for everyone
Yeah.
listening. Say you have a $25,000 account.
Go.
1% risk means your absolute maximum loss for this trade is $250. So that is your account risk.
Right. Now, you look at your chart and determine where your stop loss needs to go to basically invalidate your trade thesis. Let's say that distance is worth $50 per contract.
Okay, so you take your $250 risk divided by the $50 stop distance. Your position size is 5 contracts.
Exactly. But let's add a wrinkle. Say the market is highly volatile today, and to place your stop safely behind a structural level, the distance needs to be wider.
Like it's moving a lot faster.
Yeah, so it's now $125 per contract to reach your safe stop location.
So it's 250 divided by 125. Your position size shrinks to 2 contracts.
Yes, widening a stop must mathematically mean shrinking your position size.
Because the dollar amount at risk never changes. It is always $250.
Exactly. This completely removes confidence or emotion from the equation.
Well, let's talk about where that stop loss actually goes. Because the sources are very clear on a massive trap here.
Oh, the round numbers.
Yes. People place their stop losses exactly on round numbers, like an even $100, or directly on an obvious recent swing low on the chart.
And this brings us to the concept of liquidity hunting. To understand why this happens, you have to think about how a market maker's order book actually works.
Okay, break that down.
For every buyer, there must be a seller. If a large institution needs to buy a massive amount of shares, they cannot just hit the buy button, or they will skyrocket the price and get a terrible entry.
Right, they'd just be buying it higher and higher.
Exactly. They need a massive pool of sell orders to absorb all their buying.
And what happens when a retail trader buys an asset? They place a stop loss below the current price, which a stop loss on a long position is technically a sell order.
Precisely how they exploit it. Institutions can see those obvious structural levels on a chart. They know thousands of retail traders have bunched their stop-loss sell orders right at that round number.
So they aim for it.
They temporarily push the price down just far enough to trigger all those stops. The retail traders are forced to sell, the institution buys those shares at a huge discount, and then they immediately reverse the price in the original direction.
It is the most frustrating feeling in the world, getting stopped out to the exact penny and then watching the trade immediately run to your target.
Everyone's been there.
So the solution provided in the sources is to use ATR, or average true range.
Right. ATR measures the actual historical volatility of the asset per candle. Standard practice uses a 14-period setting, meaning it averages the price movement of the last 14 candles.
Okay.
Instead of putting your stop directly on that obvious structural level, you calculate 1.5 times that ATR value, and you place your stop that distance beyond the structural level.
So you're giving it a buffer.
Exactly. This creates a mathematical buffer that absorbs the normal market noise and those algorithmic liquidity hunts, keeping you safely in the trade.
I have to push back here for a second, though. If you are listening to this and you only have a $2,000 account, a 1% risk is just $20. By the time you account for the broker's bid-ask spread and the commission fees, that $20 budget is eaten alive before the trade even moves a single tick.
That is a very real problem.
Doesn't this strict 1% math force small accounts into impossible situations?
It absolutely does. The math simply does not work for standard position sizing on a tiny account. If you force a standard lot size with a $20 risk limit, your stop loss has to be so tight that normal market breathing will just stop you out instantly.
So what's the solution then? Taking a 10% risk to give the trade room to breathe is basically buying a lottery ticket.
The systemic fix is not to over-leverage. The fix is to change the instruments you trade or your capital structure entirely.
Like what?
First, you can switch to micro futures, like the Micro E-mini S&P, or use nano lots in Forex.
Huh.
These instruments tick at a tiny fraction of a dollar per point. That allows you to place a proper, wide structural stop using ATR while keeping your total risk strictly under $20.
And if you still want to trade larger sizes?
You utilize a prop firm funded challenge.
Interesting.
Yeah, you pay a small evaluation fee, which is often way less than you would blow testing a live small account. And if you can prove you follow strict risk management rules on a simulator, the firm gives you access to trade $25,000 or $50,000 of simulated capital.
And suddenly, the 1% rule becomes completely mathematically viable.
Exactly. And you keep a cut of the performance. You do not break the math to fit your account. You find an account or instrument that fits the math.
Okay, so whether you're trading a massive prop account or a tiny micro account, let's assume your math is perfect. You've sized properly. We still have to address the elephant in the room, the human brain.
The hardest part.
Your math can be flawless, but your emotions can still completely sabotage the entire session. We need psychological guardrails.
We have to create a rigid container for the trading session itself. The sources actually recommend limiting yourself to a maximum of 3 trades per session.
Wait, only 3?
Yeah. Journal data proves that win rates absolutely plummet on a trader's 4th or 5th trade.
Really? Why?
This is purely biological. Decision fatigue sets in. Your executive function just depletes. You have been processing complex visual data, managing risk, handling stress, and by trade 4, your brain is just tired.
Do you stop waiting for prime setups and start forcing mediocre trades just to feel active in the market?
Exactly.
It is the exact same mechanism as going to the grocery store when you are starving.
Great way to put it.
Your willpower is depleted, and you are going to make terrible choices. You're coming home with like 3 bags of chips. The sources also mention a hard daily loss limit of 3% of your account and a hard rule to stop trading immediately after 2 consecutive losses.
2 consecutive losses communicate very clear feedback.
Which is
Either the market regime today does not fit your strategy, perhaps it's highly choppy and your system requires a clear trend, or your own psychological execution is off.
right.
Neither of those problems is solved by taking a 3rd trade. Walking away preserves your mental and financial capital for tomorrow.
Then there is a phenomenon the sources call the exit gap. Traders consistently leave 40% to 60% of their potential profit on the table.
To understand this, we really need to introduce the concept of R, or your risk multiple.
Okay, let's define R.
If you risk $250 on a trade, that initial risk is 1R. If you make $500, you made a 2R profit. Your strategy relies on these asymmetric payouts over time.
But the exit gap shows that traders will frequently exit a winning trade incredibly early, say at a tiny 0.3R profit, purely out of fear.
Yes, they take the tiny gain just to feel the safety of a win.
Meanwhile, they will hold their losing trades far past their intended stop loss, letting a 1R loss turn into a disastrous -2R or -3R loss, just hoping the market bounces back.
It is the ultimate asymmetry of retail trading psychology. Cutting winners short and letting losers run is the exact opposite of what profitable trading requires.
It's just human nature to want to avoid the pain of realizing a loss.
Completely, but you have to accept that your predefined exit levels were chosen by your rational brain before the trade started. Once the trade is live, your emotional brain wants to take the wheel.
Rule 20 from Trader's Second Brain addresses this perfectly. It says, I will not look at my P&L during a trading session.
Such a hard rule to follow.
Right. Think of a basketball player stepping up to the free throw line. If they spend the entire time staring up at the scoreboard instead of looking at the hoop, they are going to miss the shot.
Looking at a fluctuating profit and loss column triggers an immediate chemical response in your brain.
Oh, totally.
Seeing green numbers releases dopamine. Seeing red numbers spikes cortisol. When you stare at the P&L, you completely stop trading the chart in front of you, and you start trading your feelings about the money.
So, hiding that column on your platform removes the chemical trigger. The stop loss and the profit targets manage the money. Your only job is to execute the system flawlessly.
Play the game, not the score.
Let's shift gears a bit. Your personal risk parameters are dialed in, your math is ironclad, your psychology is guarded. You are finally ready to look outward at what the rest of the market is doing by tracking institutional order flow.
Right. And the primary tool for this is the CFTC's Weekly Commitment of Traders report, commonly called the CO2 report.
Okay.
It acts as a weekly snapshot of how the largest players in the market, hedge funds, commercial banks, producers, are positioned.
But the source from Forex Fundamentals points out a massive trap here. Because wait, if I pull up the standard COT report and look at the category called commercials, aren't I looking at the smart money hedging their bets?
That is the fundamental trap most retail traders fall into. When you look at the standard report, you are looking at what's called the legacy report. But we have to look at the historical context.
Okay, what's the context?
That legacy report was designed decades ago when banks mostly just facilitated hedging for agricultural producers.
Right, farmers hedging corn prices and stuff like that.
Exactly. But today, the financial industry has changed entirely. Those same banks now run massive speculative derivative books. They act as swap dealers.
Ah, so the legacy report is lumping genuine commercial hedgers like, an airline trying to lock in fuel prices together with speculative swap dealers placing massive derivative bets.
Yes. It completely pollutes the data.
That makes sense.
It renders the legacy report blurry and largely useless for modern analysis. To get the real signal, you have to use the modernized reports.
Which ones?
If you are trading Forex, you need to look at the TFF report traders and financial futures. Within that report, you ignore the noise and isolate the leveraged money category.
The leveraged money.
That is where the hedge funds and commodity trading advisors actually show up.
And what about for physical commodities like gold or crude oil?
For those, you pull the disaggregated report. There, you track the category called managed money. Both leveraged money and managed money isolate the highly active, directional speculative capital that actually drives medium-term trends.
Okay, so if I pull up the TFF report and I see that leveraged money, the massive hedge funds are aggressively long on the euro, does that mean I should just hit the buy button on the euro to follow them?
Using COT data as a direct entry signal is a guaranteed way to lose money.
Why is that?
The data lags. It is collected on a Tuesday and published on a Friday. By the time you see it, the market has already moved. Instead, you use it as a powerful contrarian signal to identify overcrowded trades.
An overcrowded trade, meaning like everyone who wants to eat the party is already inside.
Precisely. We look for historical extremes in positioning. We use Z-scores, which track standard deviations from the historical mean. We're looking for readings above +2 or below -2.
Right.
Alternatively, you can look at percentiles, specifically when positioning hits the 90th percentile or drops below the 10th.
What happens when leveraged money hits, say, the 95th percentile of being long on the euro?
It means virtually every hedge fund that wants to buy the euro has already bought it.
Okay.
Think about the mechanics of the market. To push a price higher, you need a marginal buyer. But if everyone is already long, there is no one left to buy.
So they're just stuck there.
Right. When a boat is tipped that far to one side, it signals a massive risk of a liquidation cascade. As soon as a tiny piece of bad economic news hits, those funds all rush for the exit at the exact same time.
Oh, wow.
Yeah, they have to sell to close their longs, and the price completely collapses. COT data provides the macro context for your technical setups. It's not a buy or sell trigger on its own.
That makes total sense. Well, we have covered a tremendous amount of ground today. We traded in vague wishes for strict binary rules. We broke down the unforgiving math of position sizing and how to use average true range to place smart stops that survive those algorithmic liquidity hunts.
Very important.
We built psychological containers to protect the trading session from our own dopamine hits. And finally, we explored how to properly read institutional flow through the TFF and disaggregated COT reports, searching for those overcrowded extremes.
If there is one overarching theme to this entire framework, it is prioritizing survival.
Yeah.
The trader who lasts in the long run is not necessarily the one who predicts the market with the highest accuracy. It is the one who prioritizes not losing over being right. Your analytical edge might only give you a 55% win rate.
Which is pretty standard.
Exactly. It is your rigid risk management that turns that 55% into a sustainable career.
It really circles back to what we established at the very beginning. Trading is not this linear path where raw intelligence equates to success. Which leaves us with a final thought for you to ponder.
I love this.
If technical edge and market strategy only account for a small fraction of profitability, and the vast majority of success relies entirely on strict adherence to mechanical constraints, is the market actually a test of financial knowledge? Or is trading, at its absolute core, purely a mirror reflecting a person's capacity for self-regulation and impulse control?
A fascinating question to carry with you.
Something to think about the next time you open a chart. Thanks for joining us on this deep dive, and we'll see you next time.